Welcome to Mayor Brown's Tech Talks podcast. Each podcast is designed to provide insights on legal issues relating to technology and IP transactions and keep you up to date on the latest trends in growth and innovation, digital transformation, IP and data monetization, and operational improvement by drawing on the perspectives of practitioners who have executed technology and IP transactions around the world. You can subscribe to the show on all major podcasting platforms. We hope you enjoy the program.
Hello and welcome to Tech Talks. In today's episode, we'll be exploring the impact of the recent banking crisis on relationships between banks and FinTechs. As FinTechs grapple with the fallout from the failure of Silicon Valley Bank and Signature Bank and the stress the current economic environment has placed on other banks, the need for strong bank partner relationships has arguably never been greater. Meanwhile, bank regulators have focused their attention on both the promise and the risk of these types of arrangements. We'll be unpacking what happened with Silicon Valley Bank, why it happened, and what it means for FinTechs as they try to navigate new bank partner relationships in today's environment. I'm your host, Julian Dibbell. I am a senior associate in Mayor Brown's Technology and IP Transactions practice. I'm joined today by Rohith George, Eric Mitzenmacher, and Jeff Taft. Rohith is a partner in the Technology and IP Transactions practice here in our Northern California office, and he is also a member of the firm's FinTech and InsurTech practices. Eric and Jeff are partners in Mayor Brown's Washington, D.C. office, and they're members of the firm's Financial Services Regulatory and Enforcement Group. Rohith, Eric, Jeff, welcome. Jeff, I want to start at the beginning here and just if you could tell me exactly what happened in the case of Silicon Valley Bank. What caused the bank to fail?
It's a good question and one that people will be pondering, I think, for a long time. I mean, I think there are a number of factors that have been identified in kind of the initial news reports since the failure of SVB. A number of agencies, congressional committees who are looking more carefully at the failure and undoubtedly will produce reports identifying a number of possible causes. I think one of the only constants in Washington these days is that everyone on both sides of the aisle will kind of leverage this crisis for some sort of political gain or to leverage some sort of gain potentially. I mean, ultimately, there's going to be a number of reasons and causes that are identified, and the blame will likely be spread across a number of groups, including the management, the regulators, and possibly the regulatory framework under which the bank was operating. As for the particular facts, there was a large deposit inflow, there were rising rates that were going on, the bank had a lot of unrealized losses on the securities it's held in its portfolio. So what's surprising, though, I guess, is the rapid failure of two, large banks, Silicon Valley Bank and obviously Signature Bank. I think that was surprising to a lot of people, including myself, how quickly it happened. I mean, the mix of assets, I think, was a large part of it, and so wasn't the outflow of deposits in particular. Silicon Valley Bank had a large number of uninsured deposits, which I think kind of fueled a little bit of the uncertainty. They were also selling assets at significant losses based upon their book value because they needed to raise capital or they needed to raise funds so that they could pay back the depositors who wanted their money back. I think selling the assets at significant losses and also making a public statement about the need to raise capital certainly adversely impacted the consumer confidence in the bank. Customer confidence, I think, is an overlooked aspect of banking, but important given the basic nature of the business. I mean, in its simplest form, the business is about taking in deposits and making loans or investments with those deposits. I deposit $100 today, and the next day the bank lends, $90 to you and holds 10% as capital against the loan it made. If I come back on the following day to withdraw my $100, it's not like they can go to you, Julian, and say, hey, I need you to repay that loan today. In fact, there's a little bit of a mismatch on the liabilities and the assets that they have. There are ways to manage that liquidity through pledging liquid assets at the Federal Reserve's discount window or the Federal Home Loan Banks. However, when there's an unprecedented movement of billions of dollars in deposits out of the bank in a couple of days, liquidity at the discount window may not be enough to save the bank. As previously noted, the speed at which the bank's condition deteriorated was generally unprecedented. I think the decision to close the bank and stem the deposit run likely avoided what might have been a more public meltdown. Typically banks, when they fail, they gradually deteriorate over a course of months, unless it's something, idiosyncratic, like some sort of, insider fraud or something like that. I would note two things here that are a little different, I think, than some of the past failures and some of the past runs, in the sense that the first is social media. We're in a different age now that we live in. People were making real-time statements about moving their deposits from the bank and even potentially encouraging others to do the same. This adversely affected the confidence of consumers, I think, in the bank. And as previously discussed, this is a huge, issue for the bank when people start to lose confidence. The second thing I think that's clear from this is that people can move money relatively quickly from a bank. It's not like the 1930s where people had to wait in line outside with a bag to kind of clean out their bank account. Here, a few keystrokes and essentially you're able to move millions and billions of dollars out of the bank. And that's not just big businesses, that's consumers even can, with a stroke of a few keys, now move money. So I think that's some of the factors that caused the bank to fail. As I said, I think there's going to be a lot of post-mortem on this one to come. So, but let me just kind of leave it there and turn it back over to you.
Yeah, and there may be debates about which one of these factors was decisive or not, but really it sounds like a lot of things went wrong and had to go wrong to get to where Silicon Valley Bank ended up. On the other hand, don't regulations exist to minimize the risk of exactly this type of bank failure? Like, what kind of protections are in place from a regulatory standpoint to prevent what happened to Silicon Valley Bank, and how did those protections fail in this instance, if they did?
Yeah, I mean, people should be aware that banking in the U.S. is a highly, highly regulated business for any type of bank, especially a bank of the size of Silicon Valley Bank or even Signature Bank. Those are large banking institutions, top 25 banks, so they were subject to a lot of regulation. The regulation is not only on the banks, but also on the holding company and the consolidated entity. So there certainly is, a lot of regulation in place. Dodd-Frank created a tailored framework to impose prudential standards on banks. Those standards are based upon asset size. The initial threshold under the Dodd-Frank Act was $50 billion. However, there was tailoring. There was adjusted this limit by Congress in 2018. And then in 2019, the Fed issued regulations kind of bumping up these limits from effectively $50 billion up to $100 billion, with really more limited restrictions on banks between $100 billion and $250 billion. So that would have been the area that Silicon Valley Bank, would have fallen into. This was aimed at removing some of the regulatory burden on what were perceived as some of the regional banks. And the legislation was really passed with bipartisan support in 2018. So it wasn't as if it was just, rammed through Congress. I think it was fairly well thought out, and people had stepped back after 8 years of Dodd-Frank and kind of considered, what was necessary. Not every country tailors its regulation in a similar way to the U.S. I mean, we tailor because one size regulation doesn't fit all here in the States. The U.S. has a large number of banks. I mean, over 4,800 still. I mean, that's down from maybe 12,000, 25 years ago. And I think while we all agree that small town bank X, doesn't warrant the same type of regulation as, the largest banks, the JP Morgan Chases, the B of A's, or the like, the tiering that occurs kind of for the larger banks can present more difficult decisions when you're talking about banks between $100 billion, $250 billion, or $800 billion. I think there was an initial rush, at least, to conclude that the lack of certain requirements that would have been applicable to them under the previous regime before the tailoring went in place, such as liquidity requirements and other prudential standards, were the reason for the failure. It's unclear at this stage really whether that's in fact the case, whether that really would have made a difference. If they had additional liquidity requirements. I mean, the run on their deposits was really in some ways unprecedented, and even the liquidity requirements might not have, captured that. As part of the post-mortem review, there's certainly going to be questions related to the 2018 legislation and the decision to kind of ratchet back some of that tiering so that banks of the size of Silicon Valley didn't have the same, regulatory oversight they might have had after Dodd-Frank. And the first salvo on that, I guess, was filed on Thursday, March 30th, when the White House called on the federal banking agencies to effectively kind of revisit that tiering and kind of tighten the restrictions on banks between 100 billion and 250 billion to include additional liquidity requirements and enhanced stress testing. So those banks would be subject now to, under that thought, they'd be subject to annual stress testing rather than every 2 years. It's really up to the regulators, obviously, to kind of implement that. But I think there's going to be a lot of pressure and there's going to be a lot of discussion around that, those types of reforms. Also, the president, mentioned that as far as replacing the deposit insurance fund assets, replenishing it, given the fact that it lost probably close to 30 billion with the two bank failures, that burden not fall on the community banks, but that fall on some of the larger banks. I think that's another issue you're going to see to kind of play out over time as to whether that, in fact, will be the way it is. But that's kind of the framework. I mean, we could spend a lot of time talking about the bank regulatory framework. I mean, obviously, it's very complex for any bank, but there's always going to be some shortcomings, and there's going to be some questions around the regulators, whether they were actually doing, if they had done what they were supposed to do and that. So everybody's going to have to defend themselves in this one.
Right. Yeah. No. And back to the case of Silicon Valley Bank. Like you're saying, a lot of room for finger pointing, who did what, who didn't do what, could it have been prevented? But at the end of the day, it was not prevented. Silicon Valley Bank did fail. And so what is the effect of that, Rohith? Can you talk a little bit about the impact that this failure and the fallout has had on fintech companies?
Yeah, sure. Well, I think there were a couple of areas of immediate impact that are worth highlighting. First, Silicon Valley Bank was the bank of choice for a significant number of venture capital funds and tech companies. The bank had been around for 40 years. It was started in the Bay Area specifically for entrepreneurs in the tech companies. So, it was offering lines of credit and loans to startups that other banks at the time wouldn't even consider offering to companies that really don't have cash flow. And they offered, in addition, personal loans to founders too. So that they built a pretty loyal and dedicated base in the tech community over the years. So, all that is to say that Silicon Valley Bank held deposits for a number of fintech companies, sometimes all of their business accounts and all their funds. And the seizure on that Friday, that March 10th, I think it was, it meant that as an immediate impact, these companies didn't have access to funds, and they had, real concern about their ability to make payroll, to receive payments, to fund, other operating expenses, real potential to disrupt their business from just not having access to their deposits. And really beyond, the companies who were banking with SVB, holding their money, at SVB. Beyond that, banks like Silicon Valley Bank actually serve a key role in the fintech ecosystem. They provide some of the key infrastructure for fintech companies to actually provide financial services to their customers. Because in short of buying a bank, it's incredibly difficult to acquire a banking license in the U.S. So, whether it's a consumer banking product like a digital checking or savings account, or a lending product like a buy now, pay later, or a payments product, whatever the case, many of these products are enabled through partnerships between the fintech and one or more banks. And SVB was one of those banks. So there were fintechs who partnered with SVB to provide things like payroll services, who weren't necessarily holding their own money at Silicon Valley Bank, but who used the bank as their payment rail. And therefore couldn't actually facilitate payroll runs for any of their customers until there was some type of resolution. So, not just the fintechs without their own company funds were at risk of business disruption, but beyond that, even if you weren't holding funds there, if you were partnering with SVB to provide financial services to your customers, you were also kind of at risk of business disruption, business impact.
So a lot of really a lot of risk of really direct impact on FinTechs directly from Silicon Valley Bank's failure. But in the end, many of these potential adverse outcomes were staved off frankly by prompt action by the Fed. Jeff, can you tell us how this was accomplished?
Yeah, so there were a number of steps that were taken. I mean, and I think these steps honestly have kind of avoided what seemed like it could initially spiral into a significant, financial crisis. I think the regulators acted quickly, and while there'll be questions as to what they did and what they didn't do and why they did it, they did act quickly over that weekend, giving comfort to a lot of depositors, especially the uninsured depositors, by indicating that they were going to use the systemic risk exception and basically cover all the deposits. Typically, when a bank fails in the U.S., the FDIC as receiver is required to use what we call least cost resolution. So they resolve the institution in a way that imposes the least cost on the deposit insurance fund. Here they use their exception to that, which obviously was approved by the other agencies necessary for that. So they guaranteed all the deposits, which obviously increased the loss that the deposit insurance fund faced. Significant loss, I think, with the two banks, like I said earlier, probably about $30 billion. So it's real money. It's the kind of money we would all pick up off the street if we saw it, right? So that's certainly something that's going to have to, be addressed down the road. What the agency also did is they established what's called the Bank Term Funding Program, which provides some sort of liquidity to banks who need liquidity. It's like the discount window, like the Federal Home Loan Bank. So I think the terms are a little bit more favorable. You can effectively lend based on the face value of the securities or the assets held. You don't have to worry about marking them to market. So I think that's helpful. That should prevent banks from having to sell assets at a loss in the market. And again, the liquidity is important because it allows you to meet demand for deposits in the event that people start showing up and demanding their deposits back. And that, again, really plays into the confidence game a little bit. I also think it's been helpful that the bridge banks were set up. That gave some comfort, again, to customers of those two banks, gave some comfort to the market. And now the bridge banks have effectively been sold off to ongoing institutions where the assets and assumptions of liability by NYCB and First Citizens has also provided more stability to the market now that there's a permanent counterparty to those customers, a permanent place where those deposits and those bank relationships are. Obviously, I think as Rohith hit on, people are evaluating their use of banks, their relationships with banks, their need for more than one bank potentially as a partner, so that they can basically, if something happens, and the failure is just one example. I mean, Silicon Valley Bank could have been hit by a cyber attack and been out of commission for a week. And if people had all their money in the bank or all their accounts at the bank, they would have had a similar issue. So I think this kind of is a wake-up call for people to kind of look at their relationships, look at their deposits, look at how their deposits might be uninsured and what they can do to kind of mitigate that. I think we're seeing a lot of clients doing that. And I think that's something that's very similar to what fintech clients have been doing with all their bank relationships, whether it's deposits, treasury management, or even their lending arrangements with bank partners. So I think that's kind of where we are right now.
Mm-hmm. And sounds like there's a lot still to think about going forward. I mean, the worst outcomes for Silicon Valley Bank and Signature Bank were averted, but is there still ongoing risk that the same thing that happened to those banks could happen to other banks?
I think there's always the concern, and I think you're seeing, a lot of news stories about banks that have similar profiles, whether it's they have unrealized losses on assets they hold on their balance sheet or uninsured deposits. So I think people are trying to identify, similar institutions for fear that those institutions, could present similar risks. Of course, by identifying those institutions and stories, you may cause people to move their deposits away. You hope that the enhanced liquidity that's being provided to these banks by the program that the Fed has set up will help them weather those deposit, withdrawals. But, there always is that concern that it's a confidence game. And if another bank were to get in trouble, I think that would really kind of hurt the psyche of depositors and cause depositors to maybe pull back even more. Now, of course, people start moving their funds into money market funds, and what if the money market funds break the buck and you have a similar issue there? I mean, so there is a potential, for overreaction, and that overreaction can also have implications.
All right, so not an isolated event here. This crisis, kind of some changes to the environment of banking. How then are we going to see fintechs responding to this changed landscape, these events and their fallout? Rohith, what are you seeing?
Yeah, I mean, so I talked a little bit about immediate impact earlier. I think that starts to get into the long-term impact here, and Jeff touched on this as well just now. But yeah, I mean, I think in my view, some people, when they heard it was Silicon Valley Bank and not I don't know Farmers Bank of Nebraska, some people took the opportunity to kind of point and say, hey, you tech companies are filthy rich. It's really on you for not doing your due diligence, not keeping an eye on where your money is and which bank you're partnering with. You should have done your diligence, known that uninsured deposits were at risk or that the bank could fail. And you know what? There's some truth to that, but I think it's easy to point the finger in hindsight. Some of our fintech clients have a very sophisticated treasury management strategy. They've got diversified bank partner relationships. They've got business continuity plans that address what happens if a particular bank goes down, and they're probably as well prepared for this type of scenario as could be. But others are earlier stage. Their focus is on building a product that people want to use. It's difficult to really ask them to spend time, energy, and money anticipating and planning for an event that caught even seasoned economists by surprise. So, or at least it was difficult to ask that. I think, as Jeff pointed out, Silicon Valley Bank's failure and the aftermath kind of bring these risks to the forefront, to the front of the mind. So, some fintechs have moved deposits to too big to fail banks. Some are spreading the risk around. There are new fintechs popping up to kind of handle treasury management for core services that they're providing through bank partners. Some have had to put in place new arrangements with banks overnight. Whatever the case, until and unless there's a blanket government guarantee on uninsured deposits, which isn't coming anytime soon, there's a need to mitigate this risk, both from a deposit side and from a service side. So, now that there's a little bit more breathing room, at least from the immediate events, I think we'll see more fintechs take a strategic approach as they enter into these bank partner relationships.
Right, and I just want to note that this is all happening in the context of bank fintech relationships having recently become kind of a focus area for regulators. Eric, am I getting that right? And can you talk about that?
Sure. So regulatory interest in the bank fintech relationship space is not entirely new. But we are increasingly transitioning from initial fact-gathering engagement to the development of more targeted regulatory and supervisory frameworks. So as a matter of history, in 2018, the United States Treasury Department issued a report on non-bank financials, fintech, and innovation. And while that report dove into certain regulatory issues and certain fintech submarkets, it largely took the approach of kicking off a more robust discussion amongst federal and state legislative and regulatory stakeholders. More recently, in November 2022, the Treasury Department issued another report on the fintech industry with a particular focus on bank-fintech relationships. That report continued the discussion among stakeholders, but it also began to pinpoint a variety of more specific risks and control approaches in areas such as regulatory arbitrage, banking system risk, fraud, information security, and discrimination. This evolution of engagement from beginning a discussion to identifying controls has a range of legislative, regulatory, and supervisory implications, one of the more concrete of which is parallel evolution in the compliance management standards of the major banking and consumer credit regulatory agencies. The OCC, the FDIC, and the CFPB have long imposed third-party risk management or vendor management obligations on the entities that they supervise. Those obligations are grounded in risk reduction ideals that largely are agnostic to product or structure and are flexible as to the capabilities, needs, and risks of any given supervised entity. But mirroring the Treasury Department's increasing specificity about fintech issues, regulatory risk management expectations increasingly have adopted and addressed the particular structures common to fintech markets, specifically including lending partnerships, BIN sponsorships, data processing and aggregation services, and AI and machine learning services. The OCC in particular, as relevant to national banks and federally chartered institutions that they supervise, has reissued its third-party risk management guidelines in both 2013 and 2020, in each case providing more granular treatment of emerging fintech partnership approaches to the provision of traditional banking services. And it recently reorganized certain operations into an Office of Financial Technology as of October 2022 as a way of supporting those third-party risk management oversight activities and other fintech initiatives. Additionally, an interagency proposal dating to 2021 seeks, among other enhancements, to formalize a similar expansion of focus on fintech models and specific fintech submarkets across the federal bank regulatory landscape. I think key takeaways from this process are that banks are likely to be subject to increased oversight expectations with respect to their fintech partnerships over time. And on the other side, fintechs are likely to face more robust initial diligence and periodic monitoring and auditing by the banks with which they partner.
Okay, so what kind of diligence process then might fintechs expect from banks today, given this heightened focus?
So the answer is somewhat frustratingly, and it depends. It depends on the fintech services, their size, their business model, and so forth. Everything would need to be tailored to the particular fintech bank relationship at issue. That said, there are certain areas that banking regulators have appeared to be more focused on than others. Those include AML and sanctions compliance, discrimination, and control of, or at least visibility into, proprietary credit and pricing models that may be implemented more substantially at the fintech level. These focuses predate the current SVB saga, and other than possible credit model oversight, they don't have a lot to do with the specific types of risks that we see as particularly heightened by recent events. But in a world in which there's increasing pressure on banks to manage fintech risks generally, pushing more significant compliance and reporting requirements in these focal areas down to partner fintechs represents a visible and tangible step that a bank will be able to take to demonstrate that it recognizes and controls the overall risk associated with bank-fintech relationships. And it's therefore a way to generate goodwill with their regulators at a time of industry stress, even if there are other issues still to address. So these are areas that we would expect to see increased oversight of fintechs by banks. They've been building for a while, but they're even more likely to be materially heightened going forward.
And Rohith, what about in terms of contractual rights and remedies as between the banks and the fintechs? How do you expect to see these concerns for banks that Eric's been talking about carry through into their contracts?
Yeah, so there's a whole host of different contracts, different contexts, right, for bank fintech partnerships, depending on whether it's a lending or payments or consumer banking, so on. Each agreement and arrangement has its own kind of set of issues, but in terms of what to expect kind of across products, there are probably a few things to keep in mind. So first, some context. I started my career doing tech contracts for big financial institutions, so I'm very familiar with how big banks and how the compliance and third-party risk management functions, in particular at big banks, how they manage third-party relationships. And if you're a fintech and you've tried to partner directly with a big bank, you're probably familiar too. There's always been a very robust process that third parties have to go through that can be time-consuming and sometimes frustrating for tech companies that are used to moving quickly. But there are a number of smaller banks who have made it a priority to partner with the fintech ecosystem, and that could be for a number of different reasons. There's an opportunity to reach a new or broader market segment that the bank can't through existing channels. It may be a way to diversify their lending portfolio. It may be that there's some regulatory arbitrage. Maybe there's an ability to take advantage of small bank exceptions or exemptions, like the Durbin exemption and so on. Whatever the reason, these banks have built the technology infrastructure themselves that are necessary to integrate with fintechs, or they've partnered with tech partners that provide that integration layer. And they've also been historically known as fintech friendly in terms of the whole process of entering into the relationship contracting. But with the clear emphasis by regulators on third-party oversight, third-party risk management, and particularly in the context of bank-fintech relationships, and again, particularly with respect to community banks, what I think you'll see is that depending on the arrangement, there may be a few different areas where banks may focus more attention in the contracting process than fintechs may be used to from prior engagements. First, I think you'll see the ongoing compliance oversight obligation reflected in the contract with more robust audit rights, with obligations regarding responding to the bank's compliance-related requests, requirements to participate in certain annual reviews. Generally these contracts all have included language that they're subject to the oversight and supervision of the bank, but I expect more and more we'll see more precise language with respect to these rights and restrictions and requirements. Next, I think you'll find that the bank may reserve certain rights to mandate certain changes as they may be necessary to ensure compliance with its own laws. The fintech obviously wants to control its customer-facing product, but the bank is responsible for making sure that the program overall complies with laws that are applicable to the bank. So it's their responsibility to interpret and direct compliance with those laws. So that may become a focus area. Another item is fourth party risk. So the fintech is the bank's third party, but the fintech's vendors are fourth parties from the perspective of the bank. So, historically for critical tech vendors, banks have always had some level of oversight and control over who the vendor engages as a subcontractor, but in these fintech relationships, that has not always been the case. So I think depending on the nature of the arrangement, you'll see more focus on fourth party diligence and potentially control or oversight. And I could go on, but let me just mention information security assessment, business continuity planning, customer complaint handling, all areas where banks have robust third-party oversight programs that which they may focus more attention on these bank-fintech relationships going forward. But at the end of the day, regulators have provided a framework for how banks should interface with and contract with third parties, whether it's a tech vendor, a referral partner, or a fintech partnership, taking into account the level of risk to the bank for that particular relationship. But yeah, not all fintech partnerships will require every risk mitigation that I've mentioned, but we've already seen in some of our more recent deals that some of these areas that were not pain points before have become points of emphasis where they, were in a new manner. So the key will be to navigate those complexities in a way that allows the bank to meet its compliance obligations while still leaving the fintech with the flexibility it needs to run its business in the best way it can.
Well, thank you, Rohith. And thanks, Eric and Jeff, for your insights today. Listeners, if you have any questions about today's episode or an idea for an episode you'd like to hear about anything related to technology and IP transactions and the law, please email us at techtransactions@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.